Intel posted its best single-session gain since October 1987 on April 24, and the question that matters is not whether the move was deserved, it is whether the underlying structure has actually changed. On April 23, Q1 results landed with $13.6 billion in revenue, roughly $1.3 billion above Wall Street consensus. Adjusted earnings per share came in at 29 cents against an estimate of 1 cent. That gap is not a minor beat. That is a 28-cent overshoot on a 1-cent baseline, the kind of divergence that forces a recalibration of the entire earnings model. But here is the tension that the headline number does not resolve. On the same day Intel hit an all-time closing high of $82.54, UBS analyst Timothy Arcuri raised his price target from $65 to $83 and kept his rating at neutral. His revised target was, in effect, the current price. The math said buy, the analyst said hold. That gap between the numbers and the conviction is exactly the fault line this situation sits on. HSBC moved more decisively, upgrading to buy and nearly doubling its target to $95 from $50 in a single move. Two firms, same data set, opposite postures. The divergence is informative. It signals that the debate is no longer about whether Intel's Q1 was real. It is about whether Q1 is a trend or a ceiling. The most analytically significant detail from Q1 is not what Intel shipped, it is what Intel could not ship, and what that implies about demand structure. CFO David Zinsner stated on the earnings call that revenue would have been meaningfully higher if Intel could manufacture enough chips. The unmet demand gap, in his words, starts with a B. That is billions of dollars in revenue sitting on the table because wafer output could not keep pace with orders. The supply constraint runs deep enough that Intel is now profitably selling chips that would normally be discarded as manufacturing scrap, units that fail premium performance specifications but are still functional at lower tiers. Customers are prioritizing availability over specs. That is not a marginal shift in procurement behavior. That is a signal that the market is structurally short on CPU supply. This matters because capital expenditure for 2026 is being held flat versus 2025, but with deliberate reallocation toward equipment that increases wafer output. The constraint Intel faces today is a manufacturing throughput problem, not a demand problem. If throughput improves, the revenue upside is already waiting. The condition to watch is whether Intel's capacity expansion timeline matches the demand window before it normalizes. AMD is facing similar backlogs, which rules out an Intel-specific anomaly. The broader CPU market is tight. That context makes Intel's supply gap a sector-wide indicator, not a company-specific warning sign. The consensus framing of the AI era has been GPU-centric, and Intel has spent 2 years being defined by what it is not. It is not NVIDIA. It does not lead on accelerators. It lost the AI training narrative early. What CEO Lip-Bu Tan said on the Q1 earnings call inverts that framing in a way that has not been fully priced into the analyst community's structural view. His statement, "The CPU is reinserting itself as the indispensable foundation of the AI era, functioning as the orchestration layer and critical control plane for the entire AI stack." The supporting data point that most coverage has underweighted, the GPU to CPU ratio for agentic AI workloads has moved from 8:1 down to 4:1. Tan believes that ratio continues compressing, potentially toward parity. If that trajectory holds, the total addressable market for high-performance CPUs in data centers expands materially, and Intel's server CPU segment, which grew 22% year-over-year to $5.1 billion in Q1, is positioned directly in that demand path. AI-driven revenue now represents 60% of Intel's total, and that portion grew 40% year-over-year in Q1. That is not a company riding the AI wave from the periphery. That is a company with more than half its revenue base now tied to AI infrastructure. Intel also hired Eric Demers from Qualcomm as its new GPU chief, signaling an intent to build data center GPUs that compete directly with NVIDIA. That is a long-horizon bet, but it is worth noting that Jim Cramer's comment on CNBC, that the biggest risks were taken off the table with Intel when NVIDIA stepped in, points toward a collaborative framing, not a purely competitive one. The geometry of that relationship is still being defined. Intel's structural progress has real thresholds that will either validate or unwind the current narrative, and the most consequential one is Intel Foundry. Foundry revenue climbed 16% to $5.4 billion in Q1, but the segment is still generating a $2.4 billion operating loss this quarter. Revenue growth alongside deep losses is only sustainable if the path to margin improvement is credible and time-bound. The Intel 18A process node has just entered high-volume production, with yields reportedly hitting a 60% milestone. External customer commitments on 18A are still being confirmed. The reported signal that Apple will use Intel Foundry to manufacture chips starting 2027 would, if confirmed, represent a step change in third-party validation, but until that commitment is public and contracted, it remains a catalyst in waiting rather than a foundation for current valuation. On GAAP accounting, Intel is still losing money. Free cash flow is negative. The stock is up 130% year-to-date as of late April 2026. The valuation is running ahead of the income statement, which means the investment case rests on trajectory, not current profitability. That is a valid framework, but it is also the framework that breaks fastest when execution misses. The downside scenario is specific. If 18A yields stall below commercial viability for external customers, and if the GPU to CPU ratio compression reverses or plateaus, Intel's premium over its current earnings base loses its anchor. The stock does not need to collapse for the thesis to be wrong. It needs only to stop growing into its multiple. The upside path is equally specific. If wafer output expands in line with the capital reallocation plan, if 18A secures one or two publicly confirmed external customers before year-end, and if the CPU to GPU ratio continues compressing through the agentic AI build-out, Intel's revenue trajectory from late 2026 into 2027 looks materially different from what the UBS neutral rating implies. Evidence leans toward the upside path holding, but only if manufacturing execution in the next 2 quarters matches the demand signal that Q1 already revealed. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.